Hello, everyone. Thanks for taking the time to tune into our panel at TechChill 2021. I would go so far as to say that TechChill is my favorite annual conference, so it's great to be here. My name is VK from ProFounders. We're an early stage fund based in London, investing across Europe. Today, I'm joined by Mary, Piotr, and Antoine to talk about the topic of innovation in European venture capital, or perhaps to put it in slightly stronger or more controversial terms, why aren't the backers of innovation innovating? Venture looks broadly the same way as it did 10 to 20 years ago. Shouldn't we be doing things a bit differently? Before we kick off the conversation, I'll introduce the panelists today and then give them an opportunity to add a sentence or two about themselves in case I missed anything. So going from sort of my top left, Piotr was previously a VC, including at DN Capital based in London. In 2019, Piotr founded Uncapped, a company that helps entrepreneurs in Europe raise money without giving up any equity in their business by offering growth capital from £10 to 10 million for a flat fee. After working at unicorns Flixbus and Dataiku, Antoine joined EQT Ventures to invest in early stage businesses across Europe from their Paris office. EQT writes equity checks ranging from 1 million to 75 million in startups and scale-ups across Europe and the US. And after working as an engineer and product manager in startups across Europe, Mary co-founded Odin. At Odin, the team is building a more community-driven, less US-centric version of AngelList. Guys, in that order, I'll let you guys say hi to everyone at TechChill 2021.
Hi, everyone. Great to be here. Thanks for inviting.
Same here. Thanks for putting this together. Looking forward to our chat.
Yep. Hey, guys. Great to be here. Also slightly nervous.
Cool. Well, there's nothing to be nervous about. So guys, it's great to have you here to talk about how the backers of innovation can be innovating themselves. I was pulling some stats from PitchBook on Friday to help think about some of the things we could touch on today. And in many ways, I was struck by how much the market has changed in the past sort of decade. PitchBook tells me that the value of deals has risen 6x 2010 to 2020. It also tells me the average deal size has almost doubled and total funds raised in Europe has also 6x to around 20 billion in 2020. But in a large way, right, VC funding is still allocated in the same way. To put it bluntly, partnerships try to eke out differentiated networks and deal flow and then sit around an IC every week and debate which companies they should be backing. Which in a roundabout way brings me to my first point that I wanted to touch on. Access to venture funding. It would be great to get a sense, Antoine, from your perspective, whether you think VCs are innovating on how they actually find deals and entrepreneurs and moving away from sort of the traditional culture of warm intros and proprietary network. And it would be great to get your perspective too, Mary, given sort of the network and community that you're trying to build at Odin, how you feel that this dovetails with this idea of increasing access to venture capital for the entrepreneur in Europe.
Yeah, thanks, VK. So I think that if you talk about the innovation in the venture space and how they find deals and entrepreneurs, what's interesting is if you look over time how it's developed. It started as a purely financial role, then over time funds emerged with a more operational approach, varying degrees of value add, and that has come through the form of operating partners supporting with hands-on approaches, people having more consultants and such. And I think that one of the latest steps in those innovation cycles has been to start thinking about how you can implement data in a more tight way in your operations, and mainly around how to source investment opportunities earlier on. And I think if you think about all this information, it kind of boils down to signal. It's just that historically signal might have been past relationships. I've heard X is starting Y with a Z from this other business. You should have a look at them. I think it's in your ballpark. And nowadays there's a lot of tools which enable you to basically automate either parts of the sourcing or the interpretation of the signal. If you think about the interpretation of the signal, it can go as far as just, there's this person who's come from a very successful business, turned into a unicorn. Have they been there during the most important growth stages, and are they fit to be backing such a, building such a business again? Are they qualified in the field that they're launching a new venture in? So I think there's different iteration cycles around innovation, and it's how we define it. And as for your second part, which I think Mary will have quite a good informed view on as well, around the culture of warm intros, I think that relationships are still very strong in the industry. And for a lot of funds, personal networking and word of mouth is still the main source of deal flow. And so whether it's within the startup community, angels, operators, relationships are still very important. And that's also why a lot of funds have also launched angel programs. The reasons for which they launch angel programs isn't necessarily only to help get more diverse people into the investment space, but also to make sure that through the relationships that they themselves have, they get access to different deal sources and deal flow.
Yeah, so for us, when we kind of first started thinking about what we were going to build at Odin, obviously one of the things that we thought about was, oh, this feels like something that people complain about quite a lot, right? Oh, it's such a network-driven business. But ultimately, I think humans were very social creatures, right? This is kind of just how the world works. I think in a lot of industries, they're like, oh, I didn't realize how much this relied on, who you knew. And I'm like, it's not just your industry, like, trust me. And for us, I think, instead of trying to change what I do think is kind of a core part of us as humans, it made more sense to kind of just try and expand the network rather than how do we get rid of the fact that it is network driven, right? So how do you, instead of having, I don't know, with some of these angel programs, I'm assuming it's a few dozen angels usually, right? But like, how can that number be 300,000, right? And then to empower more nodes in that network to deploy capital rather than, hey, I'm making an intro to you, but then, you still have to get backing from these other people in the fund, or maybe you introduce them to this other person and then they introduce them to someone else. But like, maybe instead of 10 iterations of introductions, they can get capital after, two, because, these people find it easier to get access to capital from whether it's the Odin community or, they have a community of friends and family, or, people who they've worked with before, and they can easily set up a syndicate to invest in that company instead. So that's kind of where the way we think about it.
Got it. And so actually I have two things to ask about based on what both you touched on, Antoine, and you, Mary. But actually just sticking for a moment on what you just said, as you sort of expand the network and you almost democratize access to it, do you, and I don't know if this is the case, I'm thinking out loud, but are there checks and balances that you need to build in? Does it really matter? Is it okay that you broaden the network because it's self-correcting? I haven't really thought these things through, but how do you think about it in terms of growing the network? Because at some point I wonder, is there too much noise? I don't know.
Yeah, so I think that's definitely obviously a valid concern. We don't think everyone should be putting money into really, really early stage risky investments, right? So when people talk about like retail investors, for us, it's not about letting retail invest deal by deal. It's more kind of, most of the people in our community at the moment are founders, or, some of them are exited, some of them might have just been early employees at startups. And I think those kinds of people who, maybe they've even worked in venture before, but still, you might be an associate at a VC firm and still not be an angel investor, right? That's still quite common. And for us, it's kind of like, if these people do have that risk profile, if you're a founder, you are, you're definitely the kind of person who probably isn't too averse to putting 5K into another founder, right? Founder's company. So for us, those kinds of people, we're fine letting invest in early stage deals at the moment. I think in future, if you're opening up to retail, it's more, hey, giving them access to, let's say like Passions Fund, instead of like putting in 10K into one deal, is maybe they get to put in £500 and it goes into 20 deals, right?
Got it. So actually, then touching on your point, both of you, on sort of expanding the network and how some funds have set up angel or scout programs to try and broaden their network and access. There's a lot of talk now about how mega funds are converging on Europe as a place of big opportunity. At the same time, I've been reading headlines recently about micro funds being set up. So recently we had Aldea, Enzo Ventures as well, and there are others like Tiny. Do you think that increasingly more and more tiny funds will help build out these kind of proprietary networks, and there'll be more of a movement towards, I guess, individual VCs perhaps setting up these little micro funds and making use of their networks? Or do you think the mega fund is going to come in and sort of really start to monopolize on at least seed and an early stage in Europe? That's an open one for anyone.
I can take a stab at it at the beginning. So I think that it really, here the three of us today, and even you, VK, for pro-founders, we all come in at different stages and at different moments, and I would say moments in the entrepreneur's life. And what's important to keep in mind is what the entrepreneurs are getting out of the solutions that we're offering. And if you think about those mega funds, I think that here what I think about that is you think about more growth stages and the value of money, that how it can bring value to your business. Do you need as much operating support? Do you need as much help from your network of angels or the network of people who are part of Mary's, Mary's nodes? It really depends. And I think that's important for the entrepreneurs and the founders to be aware of all those financing solutions, because that's what gives you more leverage in your conversations. And whether it's, you're using Uncapped to finance your growth, which helps you then raise at better terms for your next funding round, whether it's at the earliest of stages, get off the ground no matter what. You want some people are repeat entrepreneurs, for example, and they have their own playbook and they don't necessarily want operating support. They might just want the cash. And that can be an option as well. And I think it's something that we should respect, even if it's not necessarily the model that we as VCs are used to hearing, right?
100%. Cool. And then to touch on what you also said, Antoine, then about the role of data, and I might ask Piotr to start with this one. Piotr, I know part of the promise of Uncapped is to plug into new and unique data sources so that you guys can provide better, faster credit decisioning. Antoine, I know you guys at EQT also have Mother Brain. I'd love to get your thoughts on the use of data in allocating early stage and growth capital. Is it overhyped? How are you guys using it? And do you see it really working? And do you see that starting to be used by other funds? I'd love to understand from both your perspectives the use of data.
So, we use a lot of data. I think, I wish I had so much data when I was at VC. Frankly, like the most of the underwriting engine was built, or like large part was based on my experience at VC, right? So, and we now do all the VC analysis, but it used to take me days or weeks as a VC. Now we have it in a literally matter of seconds, right? Like all the cohorts, retention, anything you want. And going deeper, right? Because if you have direct access to the customer's e-commerce payment processor, you can see, how much returns there are, like fraud levels, like AOV, how is it changing? We have direct access to their Google, Facebook. You can have really amazing insights. And what we're doing really proves that I think you can do a lot of investing based on the data, especially if you're looking for a more of a short-term decisions. I still don't think that anyone will make a multi-million 10-year-long VC bets purely based on the numbers. Although I think when you see what the big funds like Tiger Insight are doing, I never worked there, but I don't think they're far off from that already.
Yeah, on that part, I think maybe maybe they're more betting on just like solid trends they've seen elsewhere than the actual data they're seeing, because I mean there's a bunch of businesses that I think are, as you said, on the short term you're able to bet on them, but at the end of the day, especially if you're investing in the early stage, and VK you can feed into this as well, you're more about the team and their execution. As you grow bigger, maybe that's where it matters less. You have a management team in place, you have PMF, your market is growing, and maybe you could have a future in which you automate the decisions, as you're saying. I think what you were saying around the volume of data you have is quite interesting, because tied to what I was saying earlier on, I think now funds have realized that because of the level of inbound and the level of data that is collected in theory by VCs, you should be able to aggregate that and have a competitive edge as you amass that data over time. And what I think is exciting about businesses such as yours is that you can definitely see a future in which you're able to help businesses in better understanding their business. When you talk about cohort and retention, those are things that a lot of the businesses which apply to you, I'm sure, might not be super familiar with either. And so, there's definitely an incentive to feed that back to them. On our side, with regards to Motherbrain, so Motherbrain is our internal tool that we use for both as an internal CRM, but also as an opportunity to source investment opportunities. So it's both deal flow and sourcing. And so in terms of hype, well, I guess I use the platform every day, so I wouldn't say it's hype. I think it's more around the expectations management and what you expect of it. If I wouldn't be telling you today that Motherbrain is there sending us a unicorn every day, because otherwise I probably wouldn't be sitting here. But the reality is that we use it as a way to reach networks that we otherwise probably wouldn't know. And one of our most successful investments, AnyDesk, is one that we found in a network in City that we didn't cover, with founders who weren't familiar with the general VC ecosystem. And that's one proof point among others that through data investments you can find interesting investing opportunities. Now, it doesn't mean that that's the only way forward. And I think it's just one evolution towards the other. If you look at PE and other asset classes, whether it's EQT or, for example, Blackstone, they're all investing in data science as well. And I think what's challenging in terms of the use of data is, as you get earlier down the chain towards, pre-seed and seed, the challenge just becomes, the challenge is just, there's no data, like when a person is left and started building a business in stealth. And I'm not saying building a business in stealth, like putting on LinkedIn stealth, but, building a business, it's absolutely no data online. Your algorithm isn't going to do anything. And so, for the sourcing part, that's just not going to help. But, there's other providers like Spectre, for example, who I know a lot of funds have been taking, that help allow funds who otherwise wouldn't be able to afford a team build on top of that and have this capability.
Interesting. I guess I don't want to, you guys feel free to say I prefer not to comment, but I'm reminded of this comedy show called Little Britain in the UK. And there's a famous scene where a computer says no. And I wonder whether you guys have experience of the computer saying no, i.e. it spit out something that is totally wrong, and there's still the value of the human being checking that. I don't know how often that happens, but
listen, at least in our case, there is no thing that computer says yes or no. We use a lot of technology, a lot of data to make the decisions, but there still are humans who use this data and make the final call.
Yeah.
Saying that, if the whole analysis is sped up and it takes you only a couple seconds to have all the information presented in a standardized way, and you have all the inputs and you clearly understand what's happening with every single driver of a business, it makes the decision process much more standardized, much more robust, and much more, you don't have as many random decisions and faster. So, that's why we can give you, millions of pounds in literally a couple hours. While VC fund it will take 3 weeks to schedule the first call.
Yeah.
No, it's true in some instances for sure.
Yeah, and the value chain or the value delivered by the VC almost shifts away from the network and more towards actually just pure old stock picking. Now it's a bit of 50-50. Do you have a great network, and then can you make good calls after that? And then it slowly moves away towards.
I actually disagree. I actually think that VCs are changing, and they have to find their own value and prove the value to the founders. The market is so competitive, but hey, I can get the 5 term sheets in a couple weeks, and you either overpay, which is some funds do that, and you see it happening, or you provide or if you don't want to overpay, you have to provide value in some other way. So hence you have platforms, you have specialized operations teams in the funds. And funds really pitching themselves to you.
The platform VC. Got it. So I guess actually, Piotr, you used to work as a VC. You're now working at Uncapped. One kind of area that we haven't touched on is venture debt. And there's some interesting statistics that are looking around sort of the penetration of venture debt in Europe versus the US, where I think in the US, people estimate it's around 16 to 20%. In Europe, it's close to sort of 6-7%. Do you think, at least in Europe, we're a little bit behind in terms of innovation and the use of venture debt in the capital structure of early stage and growth businesses? And do you see that increasing anecdotally?
Yeah, I think overall usage of debt in tech businesses is much lower in Europe versus US. I think founders are still afraid to use the debt and not familiar with the product. So there's a lot of education that our competition is not any of the other players or venture debt funds. It's actually just the unawareness and people not using debt at all on our side. But I think, you know, it's really improving. It's getting there. I think, you know, like we still like we speak to, you know, hundreds of VCs every day, every month, and still not all of them are even aware of RBF or you know, so, and they don't know how it works. So there's still a lot of education among founders, among investors. But, you know, I think it's really improving. And I think, you know, with companies like us and others, founders are much more aware and are able to build businesses in a bit different way now.
And I guess in terms of the platform VC that we were just mentioning, do you see, I don't know how you work right now with VCs, you play at a slightly later stage than I do, but do you see venture funds almost co-creating products with you? So, you know, revenue-based financing or venture debt comes in tied in with the equity round, and will these kind of, it's almost a single product financing, will that become more common, do you think? Or
yeah, it happens a lot. You know, we now have a whole team dedicated to VC relationships. I think we have now 4 people on a team just dedicated to talk to the funds and work alongside them in funding the companies. And it's about funding their portfolio companies, doing deals together, sending deals either way. You know, I think, as I said, we see that it's a very symbiotic, and, you know, very often we see our companies were good clients, but we can't put any more debt in them because it's just too risky. And, you know, we help them raise a VC money, or VC funds are like, hey, with our portfolio companies, I think, you know, they could raise now, but maybe it's better if they raise in 6 months. There's a lot of good stuff happening. Can you guys fund them a bit? And, you know, then they'll raise in couple months later.
got it. Cool. So I'm going to switch tack ever so slightly away from capital structure and a bit more chat about VC as almost like an asset class. So recently I noticed that Passion Capital in London, early stage VC, opened up part of their fund on Cedars, crowdfunding. So it already closed, but part of the fund they were then opening up for retail investors. Clearly, you know, there's been a huge boom, and it's very much in the zeitgeist of retail investing. So people interested in investing in crypto, stocks, alternative assets. You have companies like Otis that are fractionalizing luxury items. Should we, do you think, and Mary, you sort of touched on this before, should we be opening up VC as an asset class to retail investors? Is now the time to seriously take a look at this as part of everyone's sort of way that they allocate capital and as part of their sort of savings plan, etc.? Or are we not quite there yet? And is it still only for the select few?
I think more people would if they could, right? It's just at the moment it's easier to, I don't know, put £1,000 into stuff on Crowdcube, or, you know, kind of just gamble it at the bookies than to actually put this in a fund. So I think there will be a trend in more VCs doing this, and I think when that happens, I mean, there's way more capital out there than ways to deploy it currently, I think, right? Even if yeah, if everyone actually did get access to VC, there's still not, I think, as many good VC firms that could even handle making that possible, right? Where everyone who wanted to deploy that capital could.
Yeah. I mean, how long, Antoine, do you think before EQT decides that they're going to raise a retail fund? And
that's a very good question. Given that EQT the group is listed, I'd be curious around the different, you know, structures around accredited investors and how you could actually structure that. I think that in Europe, what's interesting is that, you know, there's a lot of different initiatives spinning up around financing, and what I think is the main bottleneck, whether it's venture debt or such initiatives, is always you know, education around the financial products. Because the problem, I think the problem for which venture debt isn't as developed in Europe is mainly because there's historically been a stigma around the bad rates that were given when, you know, when raising venture debt as well. And so a lot of fund managers have been burned by that in the past and maybe aren't willing to recommend it now, although it might have changed. And I think it's the same thing for, you know, opening up funding alternatives to smaller investors. I think it's about making people understand the value of such instruments. In France, for example, the French investment bank BPI, they opened towards the end of the year private equity fund. So they created a portfolio of 1,500 companies, and they allowed people to invest. I think it was as little as 5,000 euros. And that is one step in the right direction. Of course, it's still, you could still say that this is a high bar, but relative to, the 20K, 100K, 200K that you would have to put into other funds, it lowers the bar. And I think that gradually people will have that. And I think that this type of investment will fit into the broader just democratization of financing, and the people who will use those methods of financing will be in competition around funds who don't necessarily have a value add and are just providing the capital. It's just, one other element in the big chain of financing.
Right. Cool. Guys, I'm just keeping an eye on the clock, and I'm worried about our time running out. I guess I'm trying to prioritize what sort of last questions to ask. I'll ask one penultimate one before I want to end the session on a slightly frivolous and less serious note. The one question, and feel free to say pass, and I will answer it myself. I guess, what's the one kind of innovation that you guys are excited about in early stage and growth funding in Europe? What do you think is going to be the big change over the next kind of decade? And I'll let the floor open to that, and then if no one wants to say anything, I'm happy to take it.
I don't know if this is going to happen in the next 5 years, but this is what I hope will happen, right, with the trend in increasing access to more people. For me, one of the, if you look at kind of things like On Deck, EF, these kind of company builders, On Deck's obviously kind of an educational thing, right? I actually think hopefully the trend in increasing access will allow more of these companies to be built. Like, let's say you had a retail funded EF or YC, right? That's pretty exciting for me. Or, instead of On Deck requiring people to pay to go on the course and build companies, right? Imagine if university courses were literally funded by people like you or me, and I was like, hey, I would love to put money, £5,000 into something like EF. They go and pick a bunch of people who are researchers and commercial people, and then they start building companies in, I don't know, climate tech. That would be pretty exciting for me.
Cool. I was going to say, I sort of feel like the one thing I'm very much looking forward to, and it is around the same point around access, is the increasing use of data, even in the early stage. I mean, there's a lot right now around diversity and inclusion, and I'm very much looking forward to the day when a lot of the kind of pre-screening and sourcing can be, done via data to try and eliminate some of these tough diversity and inclusion questions that we face as investors. That's personally the one innovation I'm excited for, at least at the early stage. To end the session on a slightly lighter note, and I did message Antoine about this slightly earlier today, so it'll be interesting to see if he's changed his tack on this. One thing I've noticed, and I'm sure everyone has, is meme culture on the internet, and how actually meme culture over the past couple of months has had a huge impact on financial markets. So, obviously there was the whole GameStop. I don't want to say fiasco because it wasn't necessarily a bad thing, but there was the GameStop. Now clearly Elon Musk is having a big impact on Dogecoin and crypto. One thing I would wonder is, has meme culture seeped its way into venture? I don't know if you guys have any thoughts on whether you think meme culture is relevant to venture and whether there's some innovation to be had with memes, but I'll let you guys take that.
But it did that. Of course, it did, right? Like there's Turner Novak, and a lot of other funds who are getting a lot of deal flow already through the memes. So I think but I think you have to think about it in a bit broader sense. It's just the meme is just a part of just a marketing strategy. It's just a differentiation, right? Like suddenly you appeal by doing memes and these funny things, you show that you actually understand the society nowadays and the culture, and founders can find a good partner to you. No founder wants to work with someone 10 years older who doesn't understand the business they are, and especially if you're doing something in social or more innovative parts of the economy. And I think this is the way to basically signal to the entrepreneurs, hey, I understand the space you're in, understand what you're doing, I'll be a good partner to you.
Yeah, it's interesting. I was reading about Banana Capital recently, which recently raised its fund in the US, and it's entirely based off an internet following. And venture has always been tech driven, right? And necessarily part of that is around partly being a geek, partly engaging in internet culture. And I'm glad to see, like you say, Piotr, it's the internet fulfilling part of its promise to create connection and meaningful connection, and the ability to raise a fund off that kind of culture is great, because it means no lower barriers to entry. And yeah, ultimately the internet fulfilling part of its promise. I know Antoine is an active memer, so looking forward to some of his meme-related tweets and blog posts.
I'm working on changing the limited partner agreement to include memes. No. Jokes aside, I mean, as you were saying in the discussion we were having before about it, what I was saying is that I think it signals a lot around consumer habits, which is what you were saying, Piotr. I think that it's as much signaling as it is just a means of communication, and I think that relates to what you were saying around the marketing strategy. If it's one amongst others, and I think that overall, if it helps democratize the way people relate to venture and help people understand it better, then sure, why not? And as you said, it's a form of content that I personally enjoy, and I think if other people get to understand complex concepts through it, then that's great.
Yeah, I saw that Index started a TikTok channel,
Yeah, sort of. Yeah.
I think if this is the way to reach entrepreneurs, why not?
But their TikTok channel isn't memes, at least not yet. Maybe they'll see it and they'll start putting memes in there.
Not yet, right?
So some Index choreographies.
Yeah, I'm looking for Antoine's also going to put in for a promotion to become Chief Meme Officer of EQT Ventures.
CMO.
Cool, guys. Well, I think we've run up on our time. I had one or two more questions, but honestly, don't want to run over. I'm afraid the TechChill guys will have to cut us off. Thank you so much for spending half an hour to chat about innovation. It's really nice to get some sort of young, kind of fresh-faced people talking about VC and early stage investing. Thanks very much for your time. We'll speak soon, and hopefully the rest of the people watching this, they're going to have a great TechChill 2021.